Hello, Charlie here, and today I wanted to talk to you a little bit about what we're thinking about right now as far as when the stock market is down. What are some opportunities maybe that we can take advantage of um, other than what we always talk about: save more money, invest, dollar cost average. While stock mutual funds are down, we can buy more company stocks while they're lower, right? We've talked about that a lot. But one thing I want to talk to you today is about rebalancing. What the heck is rebalancing? It's almost a word that is just some of these words we use so often become cliches. It's like, oh yeah, I'm going to rebalance. What does that mean? What does that look like? How do we do it? And why do we do it? So I'm going to share my screen with you today and show you just a couple examples. First, I'm going to share, I believe it's a graphic from Vanguard here that's going to pop up. Yep. So that's what we have first. Basically, what the heck is rebalancing? Well, basically, when different asset classes, stocks, bonds, um, in different parts of the world, like international stocks, let's say, or small U.S. companies, all of those are asset classes, um, and they perform differently in different markets. For example, large U.S. stocks right now are down, but small U.S. stocks are down even more. International stocks, emerging market stocks, those are also down, probably more than large U.S. So, and bonds, quite honestly, are up, believe it or not, for the last 365-day period, if you look back. Um, so all those asset classes move and behave and perform differently in different environments. So they literally move and change in your portfolio. For example, what you're seeing here on the screen is you start off with a 50 stock, 50 bond portfolio on the left on this side. And then as 4 years later, as Vanguard is showing, stocks have performed great over this particular 4-year period. And guess what? You're no longer 50 stock, 50 bond anymore. You're more like, in fact, I think they say this diagram is 56% stock and 44% bond. So big deal. Why is that important? Well, this is not a huge change, 50 to 56. But if we go over several years, let's double that time period. And let's say, I'm going to make up a number just for example's sake. Let's say we end up at 65% stock. And if I can do the math here, 35% bonds, or even something else, 70, depending on how the market's done. If it's done really well, it could be 70% stock and 30% bond. So the problem with that now is that I'm a near retiree person. I've got 50 stock, 50 bond. Again, not saying that's appropriate for everyone near retirement, but it could be. So let's say that's my intention. Well, years later, the stock market has done really well. Bond market has not done as well. And now I have 70% stock and 30% bond. That's our example. Then let's pretend we have what we're having right now. Well, how does a 70% stock and 30% bond portfolio behave versus a 50% stock and 50% bond? There's a lot more risk over here, right? So you're going to get surprised. And a lot of people that are near retirement or even in retirement, if they haven't rebalanced over the years, then all of a sudden the stock market goes down like it is now, and they are shocked at their performance because they have not been rebalancing. So that's the first thing. It's basically based off of risk. I want to maintain my 50 stock, in this example, 50 stock, 50 bond risk profile. That doesn't mean I'm going to increase my performance by rebalancing in this scenario. It just means I'm going to maintain my risk that's appropriate for me. Again, this example is someone in retirement possibly or near retirement. They don't want to be surprised at the next stock market downturn. A good example of this is the 90s, late 90s. Everybody had enjoyed a 15-year bull market, and nobody wanted to own bonds. And in fact, everybody wanted to own tech stocks. You have people that are in retirement that own tech stocks or 90% stock portfolios. Next thing you know, we have a recession, tech stock bubble burst in the early 2000s. September 11th, 2001 happened. We went into a recession, or a down stock market, at least for a couple of years. And unfortunately, sadly, those people that were near or in retirement lost a lot of money. And that is a real loss because they were in retirement pulling money out, and or they had individual stocks because that was the thing to do in the late 90s. So that's the first reason. You want to maintain your risk profile. It doesn't necessarily, that case, improve your returns. It just keeps you from having more risk than you intended. So the next example, and I'll show you how we do this, because a lot of people ask right now, what are you all doing right now during this market, as it's kind of a wild and crazy time and up and down all over the place. So what are we doing to take advantage of that? If I can get my screen over here to show you the graphic I wanted to show you. So this is our portfolio management software. And this is what we're doing for our clients right now. And this is kind of the example we talked about, where this particular client is supposed to be, this is our investment game plan, 65 stock, 65% stock, 35% bonds. Okay, so now stocks are down, as we all know. Right now it's April of 2020. Stocks are down. So you can see that this allocation, this percentage, has shrunk. And this one has gone up a little bit. So this gives us an opportunity. Okay, we know exactly what to do. We look at the numbers. We need to buy about 4% stock to get back to the 65. And we need to sell about 4% bond. Now the math is not exact there because we got a little bit of cash going on, but you get the idea. So what does that do? That allows us to maintain the risk profile that's appropriate for this particular client. It requires us, if we execute this, to sell bonds which have been up the last 365 days, and to buy stocks that have been down the last month. So that essentially we're selling high and buying low. Again, this is the exact scenario where we're not trying to do something about performance here, although we do get to buy stocks low right now, which is always kind of a nice thing. But this is not easy to do. What near retiree wants to go in and buy stocks right now? But that's what rebalancing is, and that's why sometimes it's hard to do. And I'll tell you, the opposite is even sometimes harder to do. And the opposite is, let's say in 2019, we had a great year. This particular portfolio, let's just say, I'm going to use extreme numbers just for an example. Let's say that stocks in 2019 did really well, which they did. And let's say they went all the way up to 75% stock. And then bonds did not do as well, although they did pretty well in 2019. Let's say they went down to 25%. We didn't change a thing. We didn't buy or sell anything in this hypothetical example. But due to the performance, that's what we have at the end of 2019. So now, client calls me and says, hey, we did awesome. This is great. Our stocks are up. And I say, time out. We did, the market was great. That's awesome. You were there to participate in that and did well. Now I'm going to sell 10% of your stocks. And they say, wait, hold on a second. Why would you do that? Well, stocks are doing great. It's 2019. Things are awesome. Well, I'm going to sell 10% of your stocks because we agreed, because of your, age, your time horizon, your risk tolerance. We agreed, our game plan was that you're supposed to be 65% stocks, not 75. So it's really hard to sell stocks, stock mutual funds I'm talking about, or ETFs, when they've gone up. So that takes a lot of discipline, but we just look at the numbers. Of course, there's a lot of communication with clients, and hey, this is what we're supposed to do. This is not easy to do, but this is where the discipline comes in. So we sell those stocks that have done really well. We sell 10%. Then we come over here and we go, all right, we're going to buy these bonds. They've not done as well, but we want to get you back to 35%. So we're selling stocks high and buying bonds low to get that particular person or client back to 65-35. Again, that's not easy to do because people are saying, wait a second, don't sell those things. They've been awesome. All right, so again, that is what rebalancing looks like from a macro, stocks, bonds. But what if you're 100% stocks? All right, what if you're 100? How do I rebalance if I'm 100% stocks? Well, let's take a look at it. This is what we do. Before I move on to that example, I do want to show you that we have a little indicator here that talks about the drift. And that drift is what I was talking about when stocks do better or worse and bonds do better or worse. There's drift in your portfolio, whether you sell something or buy something or not. So that's what that diagram looks like. And we've got it right now set. We want to know, we get alarm bells going off when our drift is greater than 15%. So that's what we want to know, and that's what we're interested in, because we're going to go in there, probably make some trades when we see that. All right, so back to the example. What if I am on 100% stocks? Let's go down here And now we have consulted with dimensional fund advisors. That's who we use. That's kind of our brain trust. We like their information. We think those are some of the smartest people in the business. So we've consulted with them. They help us determine how to invest and how much percentage of each asset we should hold. And when I say asset class, let me give you some examples. This one right here, a little hard to see maybe. This is domestic real estate. So REITs, real estate investment trusts, right? So that is domestic. Come down here, I believe we split this up a little bit. Yeah, here's the other portion. We've got some international real estate that we like to hold as well. Okay, so that's kind of the example there. That's an asset class. We believe real estate is its own asset class. International developed, another one right here. International emerging, you get the idea. Then come down here, we got large US, mid US, small, etc. You get the idea. But let me explain. The blue bar is what they actually have. The bar with the yellow or orange or whatever color that is, maybe I'm colorblind or something, but that's what our design is for them to have. Okay, so let me clear off my screen a little bit. So again, this scenario, we're assuming someone has 100% stocks. They don't have any bonds to rebalance, but we get to rebalance within asset classes. And so that's also a really good thing, because let me show you. The last 10 years, US large company, that's what this section is right here, US large, that's been the only game in town. They've outperformed everything the last 10 years since the 2008 recession. All right, now there's many other asset classes that we liked. In fact, we love small companies. Small companies over probably since 1928 have outperformed everything, every other asset class. So we like to have some of those too. So let me scroll down a little bit. In fact, show you small, because this is a great example. All right, so what's happened over the last several years is large has done really well. You can see this bar is saying, hey, you have about, I can't do math in public here, about 8% more large US than you set out to have. And oh, by the way, small has not done as well lately. So you've got about 5% less, and then about the same with mid cap or middle size, medium size companies. Okay, so you can see we have kind of a numbers formula for each class, how much of each asset class we want. So what we do now is we go, okay, these have done really well. We're going to sell them. And now we're going to buy small and mid. So we get to, again, we get to sell high, and we get to buy low. Now, this is not easy to do, because these have been doing awesome. In fact, I'll have clients that call up and say, hey, we've been doing well, 2019, not 2020 so far. And so that's great. And I say, yeah, it is great. And we're going to sell them. Well, why are we going to sell those? Because they're up, they're high, and we're going to rebalance. And now we're going to buy other asset classes that have not done as well. So I think you get the point there, but it gives us a chance to use discipline. We're not using emotion here. We're taking our emotion out of it. We have numbers that we can look at. We have warnings that go off. And we have tolerances that we're trying to keep our portfolios within. So it allows us to continuously sell high and buy low. Now, let me give you an example. We might be in a flat market, or there could be a time when there's a very boring market, stock market, I mean, and all the asset classes move slowly up together. Well, that may not present a whole lot of rebalancing opportunities like you're seeing right here. But when the markets are kind of wild and crazy like they are right now, even going down, that's going to present opportunities. That's why we have tolerances set that we're looking for using this software. That's why we have programmed this software to say, hey, show us or give us a warning or an indication when this overall portfolio exceeds 15% portfolio drift. Okay, because you got to think about the trades you're making and when you're making the trades, etc. And some people will talk about doing this on a calendar year. There's a lot of studies out there that give the pros and cons of each different way to do it. The best thing we've seen, the evidence, the studies that we've read tell us that you kind of need to set a tolerance. In this case, one of the numbers that we've heard from our consultants is that about 15% tolerance is a good time, 15 to 20%, a good time to think about rebalancing. So I hope that helps. And that's a little bit in the weeds on what we're thinking right now on the rebalancing opportunities. Please don't hesitate to reach out. And if you have any questions, we'd love to talk to you more. Check us out on leadingedgeplanning.com. We're on Facebook, LinkedIn, and look forward to hearing from you. Thank you very much.